Did you know that the global private equity industry reached a record-breaking $3.8 trillion in assets under management in 2020? Welcome to the astonishing world of private equity, a realm brimming with opportunities, but not without its challenges. Let's take a quick journey through time to understand how this industry has evolved. Private equity, in its most basic form, dates back to the merchants of the Middle Ages, who would pool their resources to fund expeditions in exchange for a share of the profits. Fast forward to the 19th century, where we see the first semblance of modern private equity with wealthy individuals and families making private placements in businesses. Now let's delve into what private equity really is. It's a type of investment where capital is directly invested into a private company or used to buy out a public company, making it private. The investors, often private equity firms, aim to improve the company's value and then sell it for a profit. One must remember, though, that the private equity world isn't for everyone. The barriers to entry are high. For starters, the legal and partnership structure of private equity is complex. The typical structure is called a limited partnership, where the private equity firm acts as the general partner and the investors are limited partners. This brings us to the next barrier: the requirements for a qualified investor. In most jurisdictions, only accredited or qualified investors can participate in private equity. These are individuals or entities that meet certain income or net worth criteria. Now you might be wondering, why such exclusivity? Well, private equity investments are inherently risky and require a high level of investment sophistication. Moreover, they are illiquid, meaning you can't easily sell them like stocks on an exchange. Understanding the world of private equity is the first step towards becoming a successful investor. So, buckle up as we dive deeper into this intriguing and potentially rewarding domain. Private equity often seems like a high-barrier club, accessible only to the wealthiest investors. Typically, those who dabble in this arena have a net worth in the millions. They are the accredited investors who can afford to put at least $200,000 into a single investment. And it's not just about having the money, it's about the ability to lock it away for a significant period. You see, private equity doesn't offer the same liquidity as stocks or bonds. There are barriers to exit. Selling your stake can take time and often comes with conditions. Moreover, there are gates on getting your money back when you want it. This means that even if your investment performs well, you can't just cash out on a whim. The funds often have predetermined withdrawal periods. The high barriers and restrictions make private equity a challenging field, but for many, the potential rewards outweigh the risks. Despite the challenges, there are several advantages to investing in private equity. So let's dive into the first three pros of private equity, which are the potential for high returns, diversification, and access to unique investment opportunities. Private equity has the potential to offer returns that exceed those of traditional investment avenues. Private equity firms aim to buy and transform companies, thereby increasing their value. This process often leads to substantial profit when the companies are later sold or go public. For instance, a firm might acquire a struggling company, implement strategic changes, streamline operations, and then sell it at a significantly higher price. These high returns can make private equity an attractive investment option. Next up, diversification. Private equity allows investors to diversify their portfolios beyond traditional stocks and bonds. This is crucial because diversification can help mitigate risk. If one investment performs poorly, others may perform well, balancing out the overall returns. Including private equity in a portfolio can provide exposure to different industries, markets, and types of companies, thereby spreading risk and potentially enhancing returns. Lastly, let's talk about access to unique investment opportunities. Private equity firms often invest in companies that are not publicly traded. These might include startups with high growth potential, well-established companies in need of a financial boost, or even entire industries that are overlooked by regular investors. This gives private equity investors the chance to participate in the growth stories of these businesses, something that would otherwise be inaccessible to them. To sum up, private equity offers the potential for high returns, a means of diversification, and access to unique investment opportunities. These advantages can make it an attractive proposition for those with the resources and risk tolerance to invest in this space. But, like any investment, it's not without its risks, which we'll explore in the next scene. The potential for high returns and diversification are just a few reasons why many investors are drawn to private equity. However, investing in private equity is not without its risks. It's like a double-edged sword, offering potential for high returns but also carrying substantial downsides. Let's delve into the first three cons of private equity. Firstly, the illiquidity of investments. Unlike stocks and bonds, private equity investments are not readily tradable. They're designed for long-term growth, often requiring a commitment of 10 years or more. This means investors can't quickly convert their investment into cash if they need to. Imagine having a treasure chest, but you can't open it for a decade. That's what investing in private equity can sometimes feel like. Secondly, there's the matter of high fees. Private equity firms typically charge a management fee, often around 2% of the invested capital, plus a performance fee, which can be up to 20% of the fund's profit. It's like hiring a personal trainer who charges you an upfront fee and then takes a cut of the weight you lose. While this fee structure motivates the fund managers to perform well, it can also eat into your returns significantly. And then there's the level of risk involved. Private equity investments are inherently risky as they often involve buying companies that are in distress or are not yet profitable. It's akin to betting on a racehorse that's never won a race. You might end up with a champion, or you might end up with a horse that never makes it past the starting gate. Either way, the risk is high. Even with a skilled fund manager at the helm, the possibility of losing a substantial portion, or even all, of your investment is very real. This is why private equity is generally recommended for sophisticated investors who can afford to take on such high-risk investments. The risks associated with private equity can be significant, but understanding these risks is the key to making informed investment decisions. After all, knowledge is power, especially when it comes to safeguarding your financial future. Let's continue our discussion on the pros and cons of private equity. Private equity offers a distinctive benefit that public markets often cannot: the opportunity for active management. Unlike public companies with thousands or even millions of shareholders, private equity firms typically have a concentrated ownership structure. This allows them to have greater control and influence over the companies in which they invest. They can actively steer the company's strategy, bring in new management, or implement operational improvements. This hands-on approach can potentially lead to significant value creation. However, with great power comes great responsibility. Active management can also be seen as a double-edged sword. While it allows for strategic decisions, it also introduces a layer of complexity and risk. If the private equity firm makes misguided decisions, the consequences can be severe. The entire value of the investment could be wiped out. Moreover, private equity investments are not immune to market forces. Like any investment, they are susceptible to economic downturns and market volatility. In fact, they might be even more vulnerable given their illiquid nature. If a crisis hits, it can be extremely difficult to sell the investment and recover the funds. And let's not forget the high entry barriers. Private equity is typically reserved for accredited investors, those with a certain level of income or net worth. This exclusivity can be a significant hurdle for many potential investors. Yet despite these cons, private equity remains an attractive asset class for many. The potential for high returns, the ability to diversify one's portfolio, and the opportunity to actively manage investments are all compelling reasons to consider private equity. To wrap up, it's essential to remember that private equity is not for everyone. It requires a high level of financial sophistication, a willingness to take on risk, and a long-term investment horizon. But for those who have the means and the appetite, it can offer an exciting and potentially rewarding investment opportunity. Private equity investing can provide unique opportunities, but it's important to weigh these against the potential risks. So after considering the pros and cons, is private equity a good fit for your retirement plan? This is the big question. We've journeyed through the intriguing world of private equity, from its history to its high-barrier club. We've examined the legal structure, the challenging entry and exit barriers, and the level of investment sophistication required. We've also considered the pros and cons, from potential high returns to the risk of loss. The key takeaway is that private equity isn't for everyone. It requires a substantial net worth and an understanding of its intricacies. But for those who meet the criteria and are willing to take on the risks, it can be a valuable addition to a diversified retirement portfolio. Remember, knowledge is power. Understanding the risks and rewards of private equity is crucial in making an informed decision. What do you think? Would you consider private equity as part of your retirement plan? Leave your thoughts in the comments section below.